If you're a residential real estate agent earning $200,000 a year and you want to grow your passive income, this show's for you. Learn the secrets other agents use and hear from experts in our field in order to guide you along your journey to investing in assets like apartment communities so that you can turn your commissions into cash flow. I'm Randall McLeod. Let's go, baby. All right, welcome back to the show. It's great to have you on again today. I am going to discuss something that I saw. Again, this is a deal-specific sort of show, and I just want to dive into talking about some of the, when I'm looking at deals, some of the things that I'm seeing, right? And so this was an operator that brought a deal to me. It's a 200-unit deal, and it's a multifamily deal. And we went through the underwrite and looked at it. The property looks great, great vintage, great year, and the sponsor team has a lot of experience. And so I like a lot of things about the deal. But when you dig into the underwrite and I started looking at it, one of the things that was really glaring and really stuck out was the fact that the exit cap rate when you go to sell the property was significantly higher or lower, meaning the property value would be much higher than the going in rate. And that typically when you're underwriting a deal and you're being very conservative on a deal, you're not underwriting for the cap rates to compress. So just a high level math, how it works. On a commercial deal, we're always targeting what the NOI of that property is. How can we increase the NOI? Because by increasing the NOI, the net operating income, we're going to increase the value of that property. So, and in order to increase the NOI, well, I guess the way the NOI is tied to the price of the property is through the cap rate or the capitalization rate. And so if you do the simple math of 5% cap rate when you purchase a certain amount of net operating income, that will yield the purchase price of the property. So for simple math, if you've got $100,000 of NOI at a 5 cap, it's a $2 million property, right? And so if you are trying to sell that property down the line, typically you will increase the cap rate saying, well, we don't know what it's going to do. We don't know if the property values are going to go up or down exactly. So you will add some basis points to the cap rate that you bought it from. So we're proud to be sponsored by Ridgeline Investment Group. Ridgeline has a track record of transacting more than $53 million in assets throughout Texas. Ridgeline is currently looking to acquire 100 to 200 unit Class B multifamily communities between 5 and 20 million in San Antonio, Temple, Waco, Tyler, and other Texas secondary markets. To learn more about Ridgeline Investment Group, visit www.ridgelineig.com. So the way the net operating income is tied into the price is based on the cap rate and the going cap rate at the time. And so it's a percentage of it so if it's a 6% cap rate at a certain NOI, then you have a certain price point. And so really when you're underwriting, you're trying to say on a conservative basis that the going in cap rate, what you bought it at, and it should actually get a little bit higher if you want to be conservative. If the market is super hot and things are just turning and burning like they had been for the last 3 years, then you may compress the cap rate a little bit, which gives you an even higher valuation on the property. So one of the red flags on this deal specifically was that the cap rate was compressing, and I don't believe that that is actually what is happening or will happen over the next few years. And especially in this current environment, I want to be super conservative with what we're looking at and the numbers that we're running. And so the deal just didn't make sense after looking at that one thing. Everything else looked great, but it's the exit sale price is obviously a very big deal. And so when I stress test that deal on either the rent's not increasing as much, maybe not decreasing the cost as much, all the different things that you stress test it with, and then you stress test it with the exit cap rate going up rather than coming down, the returns just didn't make sense. And so I just want to share that. Just make sure when you're looking at deals, if you are either investing in a sponsor's deals or if you're looking at one yourself, just know if you're going to be conservative with it or if you feel like the market is telling you that you need to be more aggressive. And that's that. As always, if you have any questions, if you want to reach out to me directly, it's rm@ridgelineig.com. Happy to chat with you about that deal or any other deals that we're looking at. If you want to check out some of the opportunities that we have coming down, then go to www.ridgelineig.com, and you can see all those there by registering as through the investor portal. So look forward to chatting with you guys. Thanks for jumping on the show, and I'll see you on the next episode.
Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.